Alright, this is another add-on video to the course. This was recommended by someone in the Discord room. They having a hard time spotting gaps. Basically having a hard time seeing high probability and low probability setups. Because the main thing that we just want to focus in on is to spot the high probability setups. So how do we spot the high probability setups? You got to know when there is a gap. If you don't understand what you're trading, you may load up the lots on a low probability setup and you may lose. So we have to understand exactly what we're trading before we get into the trade. It's called high probability for a reason. That's why I just named it that, because the win rate is very high and we need to know when we see those good setups. Okay. It's not a guarantee that you're going to win every single time. I will not lie to y'all, but the win rate is high. So we have to know when we see them. So I'm going to make this video very long and very clear. I have over, I think 10 setups or maybe 8 or 9 that we're going to walk through. I'm going to use a replay mode. I'm going to walk you through candle by candle when you will see a gap, when is a gap already closed, making it low probability, etc., etc. So right here, we're going to start to the right and we'll go all the way to the left. Okay. So right here, so the replay mode. Okay. So if we're looking at this current price action right here, this is the current price. We have gaps right here. We have gaps right here. And that is filled. So at this moment, from right here to right there, those boxes, those are gaps in the market. Now, let's play out and see what happens. Where is the replay mode? There we go. Okay, at that moment, it covered that gap in the market. Now, why is this a gap? This is a gap because it was aggressive selling and no pullbacks. If this candle right here did this, if it wicked up and then start dropping some more, this box will not be here. But since it didn't do that, the box gotta be there because that's a gap in the market. The main thing you want to look at is the right hand side of the candle. Okay, look at the right hand side. If there isn't no price action on the right hand side and it's a dramatic drop or a dramatic push, it don't even have to really be dramatic. Long as there is no pullbacks on the candle, then that is a gap in the market on the right hand side of it. Remember, on the right hand side, this would be a gap right here if it didn't fill it in with all of this price action right here. If this never came up here, that little box right there would be a gap in the market. But it came back, pulled back, and filled it in. Okay, so back to this setup. We got aggressive buying come out that area, creating a gap. Okay, and it filled in that gap over there. So it's starting to balance the market out. So let's take that off. Now, this little wick have closed in that gap right there. So now we're at this point. We still got that much to fill it in, but we still, you know, it didn't do it just yet. So let's play it out. Okay, now the market is balanced out. It looked like a complete, like a bowl or something, like a, you know, like a U. It balanced the whole market out. A gap and like an imbalance is the same thing. Okay, people use different terms. I use gaps. Okay, because a gap must be filled in, just like on Sunday. If you see a Sunday gap, it's going to fill that in. That's basically what these are. Okay, so we got the gap right here. Now we have a gap right here. Now, why is this a gap? This is a gap because just like I did with the candle over here, since this didn't have a pullback, this one also didn't have a pullback. So since that didn't have a pullback, it's a gap right there in the market. So we put a box on that last down candle, that last bearish candle before the push. Okay, so the gap is between here. That's the gap in the market. That box right there is the gap. So let's take off the gap that's causing this to be high probability. This gap right here is causing this to be high probability demand. Let's take that off and let's wait. Taps back into the zone and we'll be entering our trade right here. Stop loss would be underneath that candle wick. We'll take our 101 and we're looking for liquidity or some type of areas to fill. And they grab liquidity right there. We should have got out somewhere up in here. But that's basically gaps. Now we're gonna go through some more setups so it can make more sense. But I just wanted to break this one down really slow. Okay, there is no pullback. Look at this bullish engulfing. This little red candle. We got a strong bullish engulfing. Now if this candle came down, like I said, that will be considered low probability demand if this played out exactly how it played out. Okay, now let's go to the next setup. Replay mode right here. Okay, so let's play it out. Now when it leaves that area, wait for the next candle to see what it's going to do. It's leaving the area, but let's wait and see what happens. Okay, that don't have a pullback. This box is valid. Now again, like I said, if this candle did something like this, and then it did something like that, came back up, and then dropped, this will be considered low probability. Low probability. This is a regular just supply, no gap attached to it. Okay, no gap. Now don't say, I'm not saying don't trade these. That's what I'm not saying. I'm not saying don't trade these. Just understand what you are trading. That's all this video is for. Understand what the setup is. Okay, so if, like I said, if it have a little pullback, a little red, little wick back into that box, but it still did aggressive selling, you can take these setups. Just know it's low probability. Okay. Okay, but it didn't do that. It dropped some more, came back, wick into it, sell immediately as soon as it dropped. Right there. 101 leader runner. Where's the liquidity? Now, if you're looking now we're looking for take profits. The main thing that we're looking for is gaps looking left far as runners. Okay, so the runner should be going here. Now, why should the runner be going exactly right here? Because we also have another gap right here. Because this bullish candle never had a pullback. It finally closed it in a little bit right here, but it never tapped back into that last bearish candle before the big move up. Because at first, you gotta really think about this. At first, it was right here. Think about it. Before it pulled all the way back, before it came all the way down here, the gap was right here. Then it started playing around. Now it's making a double top. Liquidity is sitting right up here. Liquidity is sitting up here. And it came back down. When it came back down, now we still have this left. So it's still valid. So now my runner, after I get my 101, my runner should be somewhere right here. Plays around and taps into it. And you know what I'm saying? And it drops some more. But that's the safe take profit, which is right here. Because that's high probability demand. And that's why we wait for candles to break. So if it do blast through it, we don't lose. Okay. Let's go on the next setup. Take these boxes off so I won't be thrown off. Alright, so why is this low probability? Why is both of these setups low probability? They both are low probability because it had a pullback. Just remember what I said on the last setups. It left that area. Let's stretch these candles out. We're only looking at this one right here. That last up candle, it blasted out. Look at the close of it. The close of it is that low of that candle. Not the wick, but the body low. The low of that body close outside of the box. If that next candle do not dip back into that box, it's high probability. But what do this candle do? This candle dipped back into the box and then left the area. What does this candle mean right here? That means they want to let everybody in on that first push. They let everybody in on that. This little wick matters. They let everybody in on that first push. So if they come back, it decreases the chances of it dropping again because that first move, they got everybody in. That's what that means. Okay. We will want to see just a red candle just coming out of it and then coming back later. Not pulling back up the same time it's dropping that first drop though. That's what I'm saying. Okay. So since it wicked back into that box, because you got to draw the box around the entire candle. The entire candle, the higher that candle wick and the lower that candle wick. And as they tap back into it, it became low probability. Okay, let's take this off. Let's break down this next low probability demand. Why is this low probability demand? Okay, it did the exact same thing, but it decided to wick out first. Let me replay that. Let me replay that. Because I don't even think, oh, my fault. I don't even think y'all understand. This time, we had two different types. So this one over here, I'll just replay. Okay. So this time, we had a body close first, then it wicked. Over here, we got a wick, then the body close. Those are still the same. Okay. So we got something that wicked out of the box first, then closed back inside. But this one over here closed outside the box, then wicked. That's still not leaving a gap. Now, let me take this off. Let me take this off. Let's take this off. Remember, we're still looking for the last bearish candle, the last red candle. Okay. Now, if we replay this, is there a gap? No, because they filled it in right there. But is there just a gap in general? Yes, there is, but that's not a high probability demand. The gap is right here in the market. That's the gap. Because look at this candle. This candle never had a pullback at this very moment. If we're looking at the price right now, it never pulled back. This candle never pulled back to fill that candle in. So now that's an imbalance. That is a gap in the market. Okay. That's a gap. So what do? They filled it in just a little bit. It's not completely filled. So now there it is right there. Now that's still the gap in the market. But for this to be high probability demand, we can't have no wicks or anything once it leaves that first time, it cannot come back. Like you might want to write that down. Once it leaves that demand area, it cannot come back. When did it come back? Right here, when it wicked out and then closed back into the box. That is a 1 minute pullback. Okay, that is a 1 minute pullback. We do not want that. We want it just to be shooting out. You do not have to look at the 1 minute chart, but if you really don't understand candle wicks and why candle wicks exist, just know the lower time frame is just a pullback on these wicks. Okay, so if this green candle was just blasting out of this area, no pullback, and then finally came back into this area at this box right here, this one down here, then that will become high probability. But it already wicked out first. So since it wicked out first, that's a pullback, and then it took off. Not high probability. There is a gap, but we want a gap attached to demand. Okay, we want it attached to it. So now they filled in that little gap, but it doesn't matter because it's not attached to the last bearish candle. So it doesn't matter. And they almost made this invalid, but then it became invalid once it broke right here, and you could have took that. Okay. Let's keep going. Okay, now why is this high probability supply right here? Let's zoom in. This is high probability supply because look to the left. No, really don't even look to the left. Look to the right. Look to the right, and you're going to see that where is the wick? Where is this at? That didn't happen. That did not happen. It just started dropping, left that area fast, no pullback until here. It never broke the high of that supply. Valid. We will be taking that sell as soon as it dropped right here. Okay. Remember, if this happens, low probability if we get that wick. It's low probability. LP. But since that didn't happen, it came back, get the investors in for that second push, and then it dropped. Okay. Let's keep going. Okay, same thing. Like really just look at the candle. We got a drop and never tap back into it until right here. Remember, it's gonna be the same thing. Oh, that was ugly. No wick and no wick or anything until right here. You will sell as soon as it break this. Well, it never broke any candle lows until right here. So once it broke a candle low, we will be entering right here. Stop losses up here, and we're going to take our 1-to-1 leader runner because we're following our rules. Once it tap back into that area, we're waiting for candle lows to get broken because we had a high probability supply. It never broke no lows until right here, which is it broke that candle low. We'll be selling right there, and then our stop loss will be right there. Okay. I know I got some more. Okay. All right. Now, how is this high probability demand right here? Same rules. Look at the engulf, and this is a I call these MESs, or you can call them like morning, evening stars. I just call them MESs. So we got aggressive buying come out this area. Where is the gap? The gap is between right here and right here. That's the gap. That makes this high probability because remember that next candle, what did this next candle do? It just kept going up. It pulled back just a little bit, but it kept going up. And then it finally tapped back into it. We're buying literally right here, stop loss down here, and we're taking that and we're looking left. Now let's take this off. When we enter this trade, now we're looking for targets. Remember, 1-to-1, leader runner. Where could the runner go? We got liquidity over here, up here, and we got gaps in the market. Where's the gaps in the market? Right here. So at the top of that box is the gap in the market. So you can leave your runner all the way up here. Now a 1-to-1 turns into a 1-to-2. That's even better. You know what I'm saying? So that's all we're really looking for is we got to understand what we're trading. We got to understand so we can see the gap. Look at this candle. This candle is very important. This candle, like not that first candle, that second candle is important because like this may take off, but if this candle dip back into it, it's low probability. Okay, low probability. But since it didn't dip back into it, came back a little bit later. Now they want to get everybody in on that first little pullback. We getting in. The best moves are always going to be the first pullback on any setup. The first pullback is always like the reverse of a trend. The first market structure break going for like a bullish market structure break. Now we're in an uptrend. The first bearish market structure break to the downside. That's going to be probably the most powerful move because you're changing trends. Okay. All right. So now we got two high probability supplies. And why do they both look the same? They both look the same because look at how this candle came out of that green, that last up candle. It came out of that area. No pullback, no wick, no anything until it came right here. That is valid. Same thing over here. Start blasting away. Came back up, start dropping some more, and started creating liquidity down here. We got double bottoms and stuff. And then it came back up here for a trade. Your sell, stop loss up here. And now we're looking at all of this so it can fill in that market. Because, okay, if you can't see this stuff, replay mode. Because if you are entering this trade, you should be looking for liquidity or to fill in all of this because this barely have any gaps. I can just show all the gaps right now. We got a gap right here, between here and here. We got a gap from here to here, from here to here, and that's really all that matters, though. You know what I'm saying? That's all that matters. So in between here, that's a gap, and in between here, that's a gap. Because look at the pullbacks. Always look at the candles to the right hand side. This candle never came back and filled that in. Gap. This candle blasted off. What this next candle do? Never fill that in. But is there a bearish candle attached to that? Do you see any bearish candles? Do you see any red candles? No, you don't. It's all green. If it's a red candle with that gap and they never tap back into that candle, that would be high probability demand. Okay, but this stuff is just you're gonna see it all the time. Okay, you're gonna see it all the time. You just have to know when to execute on it and when to just use it as a target, because even these setups are targets too. Like say if we trade, I don't know. Okay, for anybody that want to mix their personality into their strategy. Say you traded a fib from right here to right here. I don't trade fibs no more, but I'm just going to throw that out there. Say you pulled your fib from right here to right here. You caught this little 70% entry. Where should be your take profit? If we're following the rules and we're being smart about our take profits, and our take profits are actually making sense, our take profit will be right here at supply. Why? Because we're balancing the market off and we're reaching high probability supply. I would get out right here. If I'm buying, if I'm already in this trade, I'm getting out right here, and I may take the sell. You know what I'm saying? So we're gonna finish this all these subs that I drawn out. Okay, so we got 2 high probability demands. I think these are the last ones, but where's the gaps attached to it? Let's replay it. Let's replay it. Now, look at the last bearish candle on both setups before they left the area. Look at both of them. This is the last bearish candle, which is the red candle. This is the last bearish candle before it took off. So just look at them. What left out of there afterwards? Look at the candles to the right of it. What happened? Don't look at the candles to the left. Look at the candles to the right hand side of it. It just blasts out of it. They both did. And what did this candle do? Pull back, but still left that little area. That's a gap. This blasted off, did a little pullback, then took off. At first, it was a gap right here until this pullback came. Now, the gap remains right here to right here. Those are the 2 gaps in the market, okay, attached to demand. That's what we like to trade. So you have to get good at spotting this stuff. Always look at the candle afterwards. Yes, this candle exploded out of it, but if this candle did back into that, low probability demand. The same thing. If this candle came all the way back and tapped that high of that red candle high, that wick, that high, it would become low probability, but it didn't. Let's play it out. Did back into it, almost touched the low of that demand. If it touched the low of that demand, it's invalid. Don't look at the sub no more. Almost touched it. Almost touched it, man. It's getting tough. It's getting tough. And then it takes off. That's very close. That's very, very close. But it never touched it. And then same thing for over here. Tap right into it. Left the area immediately. Okay, so watch this video over and over so this can really get in your brain, because once you understand gaps, you're going to know exactly what you're trading, and you're going to know exactly how to risk your account properly, because I don't load up the lots on low probability supply and demand. I may load up on these setups though. Gotta be real with everybody that got the course. I may load up on these setups though, because I'm just going to keep saying it. The win rate is very high with high probability supply and demand. Okay, so again, watch this video over and over so start clicking. Okay, so I want everybody to understand it, so everybody that's in a group, we can just all be going crazy, having green weeks or at least break even weeks every single week. I'm not trying to be red at all. Okay, that's all I got. Peace and love.